Good morning, good afternoon, and good evening. Hello and welcome to this Asset Finance and IFRS 16 educational webinar. I'm your host and category lead for Asset Finance, Christoph Pereira. We've worked hard to put together a bespoke asset finance solution that can be used by any public sector or charity organization. The solution allows for the acquisition of any asset through any framework. Our solution works by decoupling the asset itself from the acquisition method and financing required depending on a customer's needs. Without our solution, a customer is typically locked into manufacturer-provided financing, which is less competitive, or advisor-provided financing, which lacks transparency. In either case, return conditions and other terms aren't necessarily favorable to the customer. Our twin agreement solution provides the ultimate one-stop shop. Customers can go straight to the funding DPS where they know their acquisition requirement and have the resource to run a further competition. Where further guidance is required, an options appraisal can be sought from a leasing advisor on our framework, such as Grant Thornton or Unilink, to inform a customer on how best to acquire an asset as per their needs. A customer can then take this information and use the DPS themselves, or can use the leasing advisor to carry out a full end-to-end service, not only providing the options appraisal, but also administration of the DPS, running the further competition and terms review. Our solution provides standardized terms on 12 asset classes to ensure fair and appropriate return conditions for customers, and also ensures complete transparency in pricing throughout the advisory framework and funding DPS. If you have any questions or would like to know more about our solution, you can find our details below. Today, we're lucky to be joined by Sophie from Grant Thornton, who feature on our advisory framework. We hope you enjoy this session. Sophie, the floor is yours.
Thanks, Christoph. So, as Christoph mentioned, I'm here to talk to you today about the transition to IFRS 16, which is the new leasing standard, and the upcoming changes to financial reporting for leases as a result. Some of the impacts of these changing reporting requirements may create a knock-on effect to the decision-making process around asset finance, and very relevant to your finance functions. So I'll introduce myself. I'm Sophie McMullen. I'm a manager within the Financial Accounting Advisory Services team, and my team advise on a wide range of entities across various financial reporting issues, including the implementation of new financial reporting standards. I'll take you through the objectives of what I'm going to talk to you about today. The first one being understanding the key accounting changes as a result of applying IFRS 16. Then we'll move on to understanding how to resolve the key challenges around collation of leases and what data points are required for quantification of these adjustments. Then we'll understand how to identify key technical judgments that arise. And finally, we'll think about how to understand the route to future-proofing and maintaining those leases going forwards. Note that the lessor accounting remains unchanged under IFRS 16, and these changes are in relation to accounting for lessees. So first, let's talk about the key accounting changes as a result of this transition. IFRS 16 leases is to be applied for the first time for public sector bodies from the 1st of April 2022. There are two exceptions for public sector bodies available. Early adoption was permitted from the 1st of April 19 if the entity has at least one subsidiary, which is required by company law to apply IFRS, and total assets of that subsidiary comprise at least 10% of total group assets. The subsidiary or subs have operating leases that comprise at least 10% of all operating leases at group level, and approval to early adopt was received from HM Treasury. There's another early adoption date permitted on the 1st of April 2021 if the entity obtained approval from the relevant authority. I'll note that these early adoption dates have now passed, so we'll assume that adoption will now be from the 1st of April 2022 as your transition date to IFRS 16. However, note that under IAS 1, the likely impact of implementing new standards is required to be disclosed in the entity's financial statements for the period prior to implementation date. So this means that for years ending 31st of March 2022, i.e. the financial statements for the period before that transition date, disclosure will need to be made of the anticipated changes as a result of transition. Moving on, what are the actual changes required? So all leases are now required to be accounted for on balance sheet. As you can see from the table below, This results on the income statement by moving operating lease costs that were previously accounted for as expenses under IAS 17 into a depreciation on a right of use asset under the lease and an interest cost on the lease liability that arises on transition. Then on balance sheet, those items that were previously held off balance sheet and just disclosed as obligations now move on to balance sheet, and that requires you to now recognise a right of use asset and a corresponding lease liability. In terms of how we measure that, there's items that go into the initial measurement of the right of use asset and then subsequent, and likewise for lease liabilities. So in the right of use asset, the initial measurement comprises all the value of the lease liability at transition date, so what's still left to pay on that lease, plus any payments already made, less any lease incentives, plus any direct costs incurred and any expected costs to rehabilitate the asset at the end of the lease. Then moving forwards, subsequent measurement comprises its carrying value, less any accumulated depreciation, impairment, and any remeasurement required on that lease liability. Then in terms of the lease liability, initial measurement is the present value of all future lease payments still left to make on the lease, discounted using the interest rate implicit in the lease. If this rate isn't readily determinable from the lease document, the entity may use its incremental borrowing rate, which I'll discuss in a second. Then moving forward, subsequent measurement on that lease liability will comprise its carrying value plus interest on the lease liability, less any lease payments made, and plus or minus any lease modifications. There are some exceptions to recognising these assets. One is in relation to short-term leases. So if you have a lease term which is less than 12 months, then this is optional under IFRS 16 to whether to recognise it or not as a lease. But for entities applying the FREM, the financial reporting framework provided by the government, this is not an option, this is mandatory. You can exclude short-term leases from the scope of IFRS 16. Likewise, leases of low-value assets are also excluded under the FREM from having to be brought within the scope of IFRS 16. There's no value defined in IFRS 16 as to what low value might mean, but the guidance is stated as less than $5,000 as a de minimis, translated into whatever currency you need. It should be noted on the borrowing rate point that in accordance with the FREM, if an entity cannot determine the rate implicit in the lease, then they should use the HM Treasury discount rate. So that's provided to you. However, if they can demonstrate that another rate is more accurate to represent an incremental borrowing rate, then use that rate. There is also a portfolio exemption available. This is where a lessee can apply IFRS 16 to a portfolio of leases that have similar characteristics if they reasonably expect that the resulting effect is not materially different from applying the standard on a lease-by-lease basis. But generally speaking, you'll apply this on a lease-by-lease basis. So where your leases are of low-value items, you take each one separately unless you want to apply a portfolio exemption. This might also be a great time to look at your portfolio of leases and conduct a portfolio analysis on your existing leases, given the changing accounting treatment and presentation of leases following the implementation of this new standard. It might be a good time to see where efficiencies could be made when looking at those projected costs over the next few years on your lease portfolio. In terms of actual transition approach, there are some options available under IFRS 16, but entities applying the FREM must take what's called the modified retrospective approach. This is where you recognise the cumulative effects of initially applying IFRS 16 at the date of application as an adjustment to the opening balance on taxpayers' equity. The option to reassess whether a contract is or contains a lease has been withdrawn for entities applying the FREM. This means you must use the practical expedient available under IFRS 16.C3, which means you just apply the standard to all contracts that you previously accounted for as leases under IAS 17. There are separate transition provisions available for peppercorn leases, which I'll talk about later. I thought it would be a good point here to show you some illustrative disclosures of what this might now mean for your financial statements. These have been taken from Transport for Wales annual report, who early adopted IFRS 16 for their 2021 annual report. As you can see, the accounting policy for leases will change as a result, because you'll need to now talk about how you recognise right-of-use assets and lease liabilities, and the kind of leasing activities that you undertake as an entity. You'll also need to talk about the effective interest rate you've used in terms of calculating the lease liability, and you'll need to note that short-term leases and leases of low-value assets have been excluded from this assessment. Moving on, Transport for Wales have also included disclosure around certain transactions that they've entered into, which may on the face of it look like leasing arrangements, but have actually been assessed to not fall within the scope of IFRS 16. This is useful here to give users of the financial statements a better understanding of how you have and have not considered items to fall within the scope of IFRS 16 or not. Then moving on to the notes to the financial statements, you'll see that there's now an interest expense on lease liabilities within your finance expenses. Also, there'll be disclosures to be made on leasing of right-of-use assets, showing the closing balances on each right-of-use asset category as at the year end. Then in terms of further lease disclosures, you'll see that they've made disclosure here of the kind of leasing activities that they've entered into and the discount rate that they've applied using the government borrowing rate. They've also talked about the low value and short-term leases and what they comprise. Then there's further disclosure here on the right-of-use assets, categorised by asset class, showing your brought forward balance, which will be your balance on transition date, additions to the right-of-use assets, and any other changes such as disposals or depreciation charge to your closing position. Then moving on, you need to disclose the items that you've recognised in profit or loss. So as well as the interest expense on these lease liabilities, you'll also need to disclose the expenses relating to short-term leases and also those relating to low-value assets, which have been expensed on a straight line basis, similar to how the treatment was applied under IAS 17. You'll note here also that they've disclosed the commitments that they've made as at the year end to enter into leases that are not yet actually effective as at the year end date. This is required under IFRS 16, again, to give users of the financial statements a better understanding of what's to come, even if it's not yet included in the balance sheet. And then finally, the lease liabilities need to be split between current and non-current and shown separately in a note here. So we'll move on now to thinking about how we collate that lease data that we're going to need for our transition. When collating lease data, management will need to think about how they're actually going to identify all their leases. Then they'll need to classify them in or out of scope of IFRS 16, which isn't always a straightforward exercise. Once that's been completed, management will need to consider how to measure those leases, including making key technical judgments over lease term, options to extend or terminate, and the discount rate to use. Then going forwards, you need to think about putting processes in place to maintain that lease data. So first, let's talk about identifying leases. This pillar focuses on capturing the existing lease base, including embedded leases within contracts that might not look like leases on the face of it, and then defining a process for easily capturing those leases on a going forward basis. You'll need to think about all the arrangements you have that contain a lease. That also includes thinking about historic or old leases that still have some time left to run as at transition date. You'll need to think about how you evidence the completeness of that data for your auditors, and then also what data points within those leases, which I'll move on to in a minute, are going to be required in order to make your measurement. This might involve technical review of some complex arrangements, It might also require the use of data analytics depending on the population of your leases. And you may want to consider using third-party software, which is available, where you input the data from your leases and it calculates your asset and liability calculations for you. There are some potential issues that give rise There are some potential issues when thinking about the lease data. Have you got access to all the relevant lease documentation? Are your leases stored across a multitude of areas, such as Excel files, or maybe even paper in cupboards somewhere? Is your lease population complete? Have you identified everything that you've got? Think about the time that's going to need in collating that data. Do you have sufficient resource? There might be no centralized lease process, and you might have different systems or providers across the entity or the group. Then you need to think about how you determine what the relevant documents are and how practically you record those data points in the leases. Do you have everybody on board? Are they all aware of the information that they're, as a team, going to have to compile? And is there a sufficient audit trail? And is the existing data reliable? These two last points are very important to consider when you're going through your year-end audit process. And in my experience, the completeness of lease data and the resource, like the time it takes for people to collate it all and process all the information, are two areas where clients have practically struggled. So moving on to data points. So you need to think about when your lease start and end dates are. Options to extend or terminate early are factored into your lease liability calculation. If you reasonably expect not to extend the lease or to exercise an early termination option, you can basically cut your lease liability short to that point. You also need to think about whether there are any dismantling or restoration costs included in the lease contractually, which will factor into your asset calculation. There may be a notice period that you need to consider. There may be payments of different amounts in rents, or a rent-free period, initial payments, or incentives received that all factor into your calculation. There may be caps placed on rents. There may be non-lease components within that contract which you separate out, or there may even be something akin to a turnover rent or a rent that's dependent on an index or a judgment that you're not able to make as at the date of transition. So as I mentioned, these all factor into the measurement of our right of use asset and our lease liability. This is a replication of the table I showed earlier, but just as a reminder, the right of use asset will be the value of your lease liability, plus those payments you've already made, less lease incentives, and then those costs that you're expected to have to incur to rehabilitate or costs incurred in obtaining that lease. Your present value of your lease liability will be those future lease payments you're due to make, which again, you can cut short if you think you're going to terminate the lease early, or if you reasonably think that you're going to extend the lease, those payments still need to be factored in. Moving on, let's discuss the classification of leases. So this identifies the categorization and definition of in-scope leases for IFRS 16. There are also rules around defining a lease versus just a service, and these are all documented in IFRS 16. And future lease negotiation tactics could be relevant here when thinking about your portfolio going forward. There's a useful flowchart within IFRS 16 that helps you determine whether a contract does contain a lease. The crucial thing here is that there needs to be an identified asset. If there isn't an asset relevant to you having a right of use over that asset, then the contract doesn't contain a lease and it falls outside the scope of IFRS 16. Then you have to think about whether the customer has the right to obtain substantially all the economic benefits from using that asset throughout the period of use. If that's not the case, then again, your lease falls outside the scope of IFRS 16. Then the next point is crucial to consider whether the supplier or the customer have the right to direct how and for what purpose the asset is used throughout the period of use. If it's the customer, then you are in scope of IFRS 16. However, if it's the supplier, then you don't have the right of use over that asset. And again, it falls outside the scope. The key thing here is really understanding whether it's the customer who has the right to operate and use the asset throughout the period without the supplier having the right to change those operating instructions. Be mindful that a contract doesn't have to have the word lease in it for it to be a lease under the scope of IFRS 16. And also, specifically for those entities who apply the FREM, this framework's made clear that the definition of a contract can include intergovernment agreements where non-performance may not be enforceable by law. So it might not need to be a legal contract for it to still be a lease in the scope of IFRS 16. The key thing here is that a contract is or contains a lease if there is an identified asset and the contract conveys the right to control the use of the identified asset for a period of time in exchange for consideration. Note here that service concession arrangements are actually excluded from the scope of IFRS 16. These are accounted for under IFRS 12 instead. So moving on, here would be a good time to just talk about peppercorn leases and their specific transition approaches available under the FREM and guidance as to how to account for these. So these are leases where consideration paid is nil or nominal, which is defined by the FREM as significantly below market value. In the scope of IFRS 16, if they meet all other requirements except for the consideration element. So it's important here to consider they are still within the scope, even if no money exchanges hands. In this situation, you recognise a right of use asset initially at its current value in use or fair value. And if the asset is a heritage asset, then you measure it in accordance with the specific guidance under the FREM for heritage assets. You recognise a lease liability in accordance with the principles of IFRS 16, if there is one. Then you recognise the difference between the right of use asset you've recognised on transition and the lease liability as income under IAS 20. Because essentially what's happening here in substance is you're obtaining the benefit from using this asset without having to pay anything or a nominal amount for it. Subsequently, you measure the right of use asset using the principles of IFRS 16 and the FREM, i.e. you depreciate it over the lease term. For peppercorn leases that weren't previously recognised as finance leases under IAS 17, you'll have a right of use asset measured at its current value in use or fair value, or as a heritage asset, and a liability, which is your present value of lease payments. On transition, where there's a difference between those two amounts, that's included as an adjustment to taxpayers' equity or another appropriate component of equity, similar to how you would recognise a lease for which you're paying consideration on transition. Moving on, we'll talk about measuring leases. So this focuses on the components and the assumptions that you'll need to make that form the calculation and related leasing disclosures. Assumptions used should be documented through policy, and assurance over the accuracy of the calculation should be obtained, particularly for your auditors. This slide just goes through a few things you will need to consider, both in respect of the quantification of the lease and then maybe the discount rate. These are key judgments that you might need to make as a finance team, which might be subject to challenge from your auditors. Note though that where you're applying the HM Treasury discount rate, the government discount rate, these particular judgments around the discount rate might not be applicable. Moving on, we'll consider the last point of the agenda for discussion here today, which is maintaining leases. So this focuses on the ongoing management of leases through software selection and process design to ensure that the management software is integrated with your existing environment. Note also that this gives consideration going forward from a procurement perspective. This may impact the decision-making process in respect of entering into leases going forwards. because now all leases are going to be brought on balance sheet. You need to also think about who's going to be involved. As seen here, the people involved on transition won't just be from finance teams. You'll need to consider all the different stakeholders. There may be property management teams, there may be capital providers, journal processors and journal reviewers, and reporting teams that will need to feed into this assessment. So finally, let's just recap. So we've been through understanding the key accounting changes as a result of applying IFRS 16 for the first time. We'll have considered how to plan for the key challenges on collating the leases and considering what data points are required for quantifying this. We've identified those areas of key judgment, and you should think about whether any of these are material enough to warrant specific disclosure in your annual report as a critical judgment or area of estimation uncertainty. And then finally, you should be thinking about how to plan for maintaining and processing your lease data going forwards. And that rounds me off for today. Thank you for joining me. I've put my details and my team's details below here. Please do get in touch if you have any questions as you start thinking about your transition to IFRS 16.
That was brilliant. Sophie, thank you for an incredibly interesting and insightful session. For those of you watching, thank you for taking the time to do so. If you found the session interesting and helpful, please do leave your feedback through the link below. If you have any questions or would like to know more, we're incredibly happy for you to reach out to us. Our details can be found below. Everyone, thank you for your time. Bye for now.